right, everybody, welcome back to the deep dive. We always like to take a deep dive into some interesting stuff, and today we're going to be looking at a recent article from the Associated Press all about a stock market dip that hit on Friday, December 27th, 2024. It was that Friday right after the holidays, when everyone's kind of recovering from all that shopping and family time. So it kind of makes you wonder, was it just a post-holiday slump, or was there something more to it?
Well, one of the really interesting things is that, this dip, it actually impacted almost 90% of the stocks of the S&P 500.
Whoa,
Yeah,
90%. That's a lot.
it is a lot. And for those who may not know, the S&P 500 is the Standard & Poor's 500.
Yep.
It's a basket of 500 of the largest U.S. companies. It's very often used as a benchmark for overall market health.
Right.
So this wasn't just, a handful of companies having a bad day. This was a pretty widespread slump.
Yeah, and the article even called out those big tech giants, the ones everyone always talks about, Apple, Microsoft, and NVIDIA,
Yeah.
the so-called Magnificent Seven. Even they took a tumble. And we're talking about companies worth trillions of dollars each.
Exactly. And that's where things start to get a little tricky, because when companies like those, with such massive market value, when they decline, it can trigger a domino effect.
I see.
Because their stocks are often heavily weighted in indexes like the S&P 500, which so many investors, they use it as a benchmark. So when those giants fall, it impacts a lot of things, from mutual funds to retirement accounts, things that everyday people are invested in.
Yeah, it's like when the biggest kid on the playground trips and falls.
Yeah,
Everyone feels it.
that's a good way to put it.
So is this a sign of like a broader tech slump? Or is this just like a temporary blip?
That's the big question, isn't it?
Yeah.
And it's really hard to say for sure. But one thing to remember is that a lot of investors have been piling into tech stocks for years now,
Right.
which has driven up prices. So any sign of weakness like this dip can cause some investors to get nervous. They start thinking, oh, should I pull my money out?
Mm-hmm.
And that nervousness that can create a kind of self-fulfilling prophecy where selling leads to more selling,
Mm-hmm.
leading to even further decline in prices.
It's a panic button moment.
Yeah, a little bit.
But you know what else I thought was interesting? The article mentioned that retailers like Amazon and Best Buy also saw declines. And that seemed kind of weird to me, considering it was right after the holidays, when people are usually, just spending tons of money.
Yeah, that is a bit curious, isn't it?
Yeah.
It could be a sign that maybe consumer spending isn't as strong as some people anticipated, or maybe people were just tapped out after all that holiday shopping.
Yeah, just maxed out their credit cards.
Yeah, exactly.
Yeah.
But whatever the reason, it's definitely something to watch as we head into the new year.
Right. Okay, so we've got tech giants, wobbling retailers, slumping. Is there any bright spot in all of this?
Well, actually, yes. Believe it or not, the energy sector actually held up pretty well, even with all the market turmoil.
Really? So is everyone suddenly buying gas-guzzling SUVs again? What's going on?
No, not quite.
Mm-hmm.
But the article attributes it to rising crude oil prices.
Mm-hmm.
So, it's a classic example of supply and demand at work. Increased global demand for oil, coupled with some potential supply constraints, is pushing prices up. So even though the overall market is kind of shaky, energy companies are actually benefiting from this price surge.
So it's like their little economic side hustle while the rest of the market is trying to find its footing.
Yeah, something like that.
Okay, well, let's zoom out for a second and look at the bigger picture. The article does mention that despite this dip, the stock market is still on track for a phenomenal year. Overall, a gain of around 25%.
That's huge.
That's a lot.
It is. It hasn't happened back-to-back years since 1997, 1998.
Wow.
So even with this recent dip, the overall trend has been incredibly positive.
Okay, so what's fueling all this phenomenal growth? Is it just the Magnificent Seven, carrying the whole team on their backs?
Well, they certainly play a role, but it's not just them.
Yeah.
We've seen strong consumer spending throughout the year, a robust job market, and at least, a gradual easing of inflation. All those factors have created a generally positive economic environment, which tends to translate into a strong stock market.
Okay, so a lot of things were going right. But, there's always a but, isn't there?
Always a but.
The article does bring up this whole Federal Reserve situation and those interest rate cuts they've been making.
Right.
Can you help explain what's going on there?
Sure. So the Federal Reserve, or the Fed, as it's often called, is essentially the central bank of the U.S.
Okay.
And one of their main jobs is to try and keep the economy stable.
Yeah.
Running smoothly.
Right.
And to do this, they have a few tools at their disposal. And one of the most powerful is the ability to adjust interest rates.
So they're like the economy's DJs,
Yeah.
spinning the interest rate dial to set the mood.
I like that analogy. But seriously, By lowering interest rates, they make it cheaper for businesses to borrow money and invest, which can stimulate economic growth and, in turn, boost the stock market.
So it sounds like a win-win situation. So what's
Yeah.
all the fuss about the Fed and interest rates?
Well, here's where the balancing act comes in.
Okay.
Because while lower interest rates can be great for boosting growth,
Hmm.
they can also lead to inflation. That's when prices for goods and services start to rise and your money doesn't buy as much as it used to.
Right, right. It's like they're trying to walk a tightrope between stimulating the economy and keeping inflation under control.
Exactly. It's a tough job.
Not an easy feat.
Not at all. And to make matters even more complicated, we're heading into 2025 with a brand new administration.
Right.
And there's a lot of uncertainty about what their economic policies will look like.
Right. The incoming Trump administration.
Yeah.
And the article even mentioned he has this history of favoring tariffs, those taxes on imported goods. How could that impact things?
Well, tariffs can be a double-edged sword.
Yeah.
On the one hand, they can protect domestic industries from foreign competition.
Right.
But on the other hand, they can lead to higher prices for consumers, which can fuel inflation and potentially slow down economic growth.
So it's like this big economic puzzle with all these pieces interconnected. A change in one area can trigger a chain reaction throughout the whole system.
Exactly. And that's why it's so important to try and understand the underlying forces at play. You
Yeah.
can't just look at the headlines. You have to dig a little deeper.
You got to look under the hood.
Exactly.
Okay, so we've got tech giants wobbling, retailers slumping, the energy sector doing its own thing,
Mm.
the Fed trying to walk this tightrope, and a new administration with potentially game-changing policies. It's enough to make your head spin.
It's definitely a lot to take in. But that's why we're here, to break it all down piece by piece so you can make sense of it all.
Well said. All right, well, let's take a quick pause here, and when we come back, we'll dig a little deeper into some of these uncertainties and what they might mean for the future of the market. Stay tuned. Welcome back. So before the break, we were talking about, Trump and tariffs and all that. But the article also mentions a healthcare deal that's been making some waves. Something about Amedisys and United Health Group.
Yeah, the Justice Department is actually trying to block a merger between those two companies. It's a pretty big deal, like multi-billion-dollar deal. And it would make United Health Group, which is already a giant in the healthcare industry, even bigger.
So what's the problem? Is it just that the government doesn't like big companies?
Well, it's a little more nuanced than that.
Yeah.
The Justice Department's argument is that this merger would give United Health too much control over the home health and hospice care markets.
Okay.
And they're concerned that this could lead to higher prices and less choice for patients, especially, those who rely on these really crucial services.
So it's not just about the size of the company, but also the impact on, competition and consumer choice.
Right, exactly.
That makes sense. But didn't you say earlier that the incoming Trump administration might have a different view on these kinds of mergers and acquisitions?
Yeah, that's right. Trump has generally signaled a more hands-off approach to regulation. So it's possible that his administration might be more favorable towards this deal than the current Justice Department. It'll be interesting to see how that plays out.
Yeah, for sure. Okay, so we've got this healthcare deal hanging in the balance, a new administration with potentially different views on regulation, and a stock market trying to, find its footing amidst all this uncertainty.
Right.
Hold on, though. The article also mentions what's happening in markets around the world. What's the global outlook?
Yeah, we can't forget about the global picture. It's kind of a mixed bag out there. Japan's market is actually surging, partly due to a weakening yen, which makes their exports more competitive.
So a weaker currency can actually be a good thing for a country's economy.
It can be, especially for export-driven economies like Japan, because it makes their goods cheaper for buyers in other countries, which can boost demand and stimulate growth.
Interesting. So what about other parts of the world?
Well, South Korea's market is down after some political turmoil, specifically the impeachment of their acting leader.
Oh, wow.
And then European markets are generally up, signaling a bit more positive sentiment there.
Okay, so lots of different things happening.
Yeah, lots of moving pieces.
It's hard to keep track of it all, but amidst all this market mayhem, what are some things that you as an investor are watching closely as we head into 2025?
That's a great question. For me, it always comes back to the fundamentals. I'm watching things like corporate earnings, economic growth, and of course, inflation.
Can you break those down a little bit? What are you looking for specifically?
Sure. So when it comes to corporate earnings, I'm looking for signs of continued growth and profitability. Are companies meeting or exceeding their earnings expectations?
Yeah.
If so, that's a good sign that the economy is healthy and businesses are doing well.
Makes sense. What about economic growth? How do you gauge that?
Well, there are a number of indicators we can look at, like GDP growth, job creation, consumer spending. We want to see signs that the economy is expanding at a healthy pace without, overheating and sparking inflation.
Right, because too much growth can be a bad thing, can it?
Yeah, it's like a party that gets out of control.
Right.
It can lead to that inflation we were talking about earlier, which can really erode the value of your savings and investments.
So how do you kind of keep your finger on the pulse of inflation? Is there a magic inflation meter somewhere?
Well, there are a number of government reports that track inflation, like the Consumer Price Index, or CPI for short.
Hmm.
These reports measure changes in the prices of a basket of goods and services that consumers typically buy. So if those prices are rising rapidly, it's a sign that inflation is heating up.
Okay, so keep an eye on those inflation reports.
Exactly.
But is there anything else we should be watching out for?
Absolutely. We need to pay attention to what the Fed is doing with interest rates. Will they continue to cut rates to stimulate the economy, or will they start to raise rates to try and keep inflation under control? Their decisions will have a big impact on the direction of the market.
It's that whole tightrope walk we were talking about earlier.
Exactly.
But here's something I'm wondering. If the market is so unpredictable and there are all these factors at play, how can anyone really make smart investment decisions? It almost feels like a gamble.
Well, there's definitely an element of risk involved in investing. But it's not just about luck. Successful investors, they do their research. They understand the risks, and they develop a strategy that aligns with their goals and their risk tolerance.
So it's not just throwing darts at a stock board and hoping for the best.
Definitely not.
Okay, good to know.
It's about making informed decisions based on solid information and a sound strategy.
Okay, so research strategy key. But what about this whole idea of diversification? The article touched on that. I'm not entirely clear on what it means or why it's so important.
Yeah, diversification is a crucial concept in investing. It basically means spreading your investments across different asset classes, sectors, and geographic regions.
Why is that so important?
Yeah.
Isn't it better to put all your eggs in one basket, so to speak, and focus on the investments you think will perform the best?
Well, that might seem like a good idea in theory, but in reality, it's very risky. Remember what we talked about earlier? The market is unpredictable. If you put all your money into one stock or one sector and it takes a hit, your entire portfolio could suffer.
Ah, so diversification is like an insurance policy for your investments.
That's a good way to think about it.
Yeah, it helps protect you from big losses if one of your bets goes sour.
Exactly. By spreading your investments across different areas, you're reducing your exposure to any one particular risk. If one investment performs poorly, others might perform well, helping to balance things out.
That makes a lot of sense. But how do you actually go about diversifying your portfolio? Is there like a magic formula?
There's no one-size-fits-all approach, but there are some general guidelines.
Hmm.
A well-diversified portfolio might include a mix of stocks, bonds, real estate, and maybe even some alternative investments like commodities or precious metals.
So it's about finding the right balance of different asset classes to match your investment goals and risk tolerance.
Exactly. And it's important to remember that diversification isn't a one-time event. You need to revisit your portfolio periodically and make adjustments as needed based on changes in your circumstances, the market, or your overall investment strategy.
So it's like a garden, constantly needing tending and adjusting to make sure everything thrives.
I like that analogy. It's about staying engaged and proactive rather than just setting it and forgetting it.
Well, after this deep dive, I'm definitely feeling more informed about, the complexities of the stock market,
Wow.
but I'm also realizing just how much I don't know.
It's true. The financial world is vast and constantly evolving,
Yeah.
but that's also what makes it so fascinating. There's always something new to learn. And the more you understand, the better equipped you'll be to make informed decisions and achieve your financial goals.
Well said. But before we get too lost in the complexities of it all, let's take a quick break. When we come back, we'll wrap things up by highlighting some key takeaways and leave you with some thought-provoking questions to ponder. Stay tuned. Welcome back to the deep dive. So, after going through all of that, I'm really starting to see the stock market in like a whole new light. It's not just numbers on a screen, it's a reflection of everything. What's happening in the world, the economy, politics, it's all connected.
It really is.
Hmm.
And I think that's one of the big takeaways from our deep dive today. The stock market isn't just some isolated entity. It's a dynamic system that's constantly reacting to events and trends. both big and small.
Right, like that whole thing with the Magnificent Seven, taking a dip, it really shows just how much influence those big tech companies have on the market and how even like a little wobble from them can send ripples throughout the whole system.
Yeah, exactly. Their size and their market value give them this outsized impact, which is why it's so important for investors to understand not just what those companies are doing, but
Right.
also how their performance might affect the broader market.
So we need to keep an eye on those tech giants for sure. But you also mentioned that the energy sector is kind of doing its own thing right now, benefiting from those rising oil prices. Is that something that investors should be paying attention to?
It's definitely worth watching. The energy sector can be very volatile. It's influenced by so many factors: global demand, supply disruptions,
Hmm.
geopolitical events even. So, while it might be doing well now, that could change pretty quickly.
So maybe not a place to put all your eggs, so to speak. Speaking of which, you really stressed the importance of diversification earlier. Can you remind us why that's so crucial, especially in a market as unpredictable as this one?
Of course, diversification is all about managing risk. By spreading your investments across different asset classes, sectors, geographic regions, you're essentially creating a safety net.
Yeah.
So if one area of the market takes a hit, your entire portfolio isn't wiped out.
It's like don't put all your eggs in one basket, right?
Exactly. And it's not just about protecting yourself from losses. Diversification can also help you capture gains across different markets and sectors, so, potentially boosting your overall returns over time.
Okay, so diversify, diversify, diversify. Got it. But with so many investment options out there, how do you even know where to begin? It can feel kind of overwhelming.
Well, that's where having a clear investment strategy is so important. You need to define your goals, your risk tolerance, and your time horizon.
And what do you mean by time horizon?
Oh, that's just simply how long you plan to invest your money. Are you investing for retirement, which might be decades away? Or are you saving for a down payment on a house, which might be a shorter time frame? Your time horizon will really influence the types of investments that make sense for you.
So someone investing for retirement with a longer time horizon, they might be able to take on more risk than someone who's saving for a short-term goal.
Exactly. They have more time to ride out those ups and downs of the market.
So define your goals, assess your risk tolerance, figure out your time horizon. It's starting to sound like a lot of work.
Well, it does require some effort up front.
Yeah.
But, we're talking about your financial future here. It's worth taking the time to do it right.
Mm.
And there are so many resources out there to help you, financial advisors, books, websites. You don't have to go it alone.
That's good to know.
Hmm.
So we've covered a lot of ground today. Market trends, economic indicators, political uncertainties, global events. It's a lot to digest. As we wrap up, what's like the one key message you want to leave our listeners with?
I think the most important thing is to remember that while the market can be unpredictable, it's not entirely random. There are underlying forces at play that drive its movements. And by understanding those forces, you can make more informed decisions. So don't be afraid to ask questions. Do your research and, seek out expert advice when you need it.
Knowledge is power.
Right.
The more we understand, the less intimidating it all seems.
Exactly. And the more empowered we are to make smart decisions about our financial future.
Well said. And on that note, we want to thank you for joining us on this deep dive into the world of finance. We hope you found it informative, insightful, and maybe even a little bit empowering.
It's been my pleasure.
Remember, the market might be a roller coaster, but with the right knowledge and a well thought out strategy, you can navigate those twists and turns and reach your financial destination. So stay curious, keep learning, and until next time, happy investing.